This is the third in our Monte Carlo simulation discussion. What we're working with here is the example 10.1 from Turton et al. So there's a lot going on here, so let's just take it one step at a time. What I want to focus on first is the example 10.1 asks us to do a cash flow and profitability analysis for a project where they give us these inputs that I'm highlighting here. And what I'm going to use is the triangular probability distribution. So we're going to say that the given inputs that they give us are going to be the most likely values here. Some of them are going to just stay constant, but some of them that I've highlighted here are going to be changing. So here are our inputs. You can pause and review the inputs if you'd like. We've got the fixed capital costs for both year 1 and year 2. We've got a working capital, which is going to happen at end of year 2. We've got annual sales revenue. We are going to assume that that's going to be 75 million, and whatever value it's going to be, we're going to assume that that stays constant from one year to the next. And then the same with the manufacturing costs. So I'll talk about that a little bit more in just a few minutes. Now, what I want to do is skip down here to just a very quick review of the probability distribution function for a triangular case. And so we have our most likely value, or our expected value is going to be C. And then we will have a minimum value and a maximum value. And the thing to remember about the triangular distribution is that, of course, it can be skewed, it could be symmetric, but maybe for financial reasons, we think that this might be better than a symmetric distribution like the normal distribution, and so we want to take into account that these values can be skewed. And remember that the area under this curve is equal to 1. When we are going to use this for Monte Carlo calculations, we want to generate a random value that is going to represent the area, and then we will map that to a value that is going to be on the x-axis. And that random value, when I said it was going to be the area, it's going to be a random value between 0 and 1. It's going to represent the area that's going to be to the left of whatever that value is that we map to the x-axis. So let's go back to this table and let's look at the values here. So our expected value for fixed capital investment in year 1 is 90 million. We're going to say it can go from 85 million at the low end to 110 at the high end. You can read through and you can see what we are assuming here for the fixed capital in year 2, working capital at end of year 2, annual sales revenue. We're going to say it could be a low of 70 million or a high of 85. So a little bit skewed to the higher end. And then cost of manufacturing, a low of 25 to a high of 40. So again, skewed a little bit to a higher value. Now what I've done here is I've generated a visualization of these triangular distributions for these input variables, and I'm not going to go through this. I went through this in class notes, and I went through this a little bit in an earlier video, so I'm not going to go through the details, but this is what those values look like. And so you can see that none of these are symmetric. They're all skewed a little bit, they're all skewed a little bit to a higher value. Whether or not that's totally realistic, that's up to other people to decide, and you can think about that. If you want to adjust these, you can. Another thing that we're going to do, well, let me back up. Let's just go through the mechanics of the calculation. So what we're going to use, and we've seen this before, I'm going to drag this over here. What we're going to use is we're going to use the inverse of the triangular probability distribution. We specify a random value, which is going to represent the area to the left, and then we will map out, we will actually calculate what that value on the x-axis is going to be when we reach that area. And so this formula was given to you in previous videos and is given to you in your class notes. You can adjust it. One of the things that I want to highlight is that this formula, this inverse triangular distribution, function, it is going to call the probability value more than once. And so we need to have the random, when we are using Excel, we need to have this as a separate cell, because if the random generator function is called within an Excel formula more than once, say twice, it is going to give us two different random numbers, and we do not want that. We want that random number that represents the area to stay constant within that particular cell. So that's why I've broken this out, and why this is broken this out here as a separate cell, so that we are not calling random parentheses more than once within this, because it's going to end up giving us very similar numbers in the final analysis, but it's not the correct way to do it. So we do that using the random number generator, and then with this formula that I've already entered, all of this has already been done, so I don't have to do any typing here. We can generate what the simulation values are for the that we're going to put into our cash flow table. Now, what we're going to do then is we're going to use these numbers in our cash flow table. So you can see the fixed capital cost for year 1, and then we have the investment for year 2, which is going to be the fixed capital investment for year 2 plus the working capital. So there you go there. Our depreciation is going to be based on that fixed capital costs. And then notice that we're going to take the revenue. The revenue comes from here. We are assuming that that revenue is going to stay constant throughout the entire project. Whether or not that is a good assumption or not, one can argue, but that's how we're going to do this calculation for now. Notice that we add, in the final year, we are adding our salvage value, right? We are adding our salvage value to the revenue. That's where that should show up. Also note that our investment, what are we recovering? We are recovering our land, and we are recovering our working capital. So that's another thing to remember about the way we do these calculations for these projects. Cost of manufacturing, whatever that is, we are assuming that it is going to be constant throughout the life of the project. Again, whether or not that is a realistic assumption, maybe we should have revenue being able to change every year according to a triangular distribution, or we should have manufacturing costs being able to change every year according to a triangular distribution function. If you'd like to include that kind of complexity, you can do that. Here we would just need to do some extra calculations within this cash flow table. So the rest of the calculations here are pretty straightforward. We can go through this, and I'm not going to go through the mechanics of setting up the Monte Carlo. We're going to do this 1,000 times like we've done before, and we're going to track the net present value, which is going to be, we did a net present value here, so we'll do that, and then we're going to track the internal rate of return. And the internal rate of return is an Excel function, and I've got the rate here. I should have it's 10%. I should have used a cell reference, but we'll leave that here for now. So the internal rate of return. Actually, let me change that now just to make sure that we well, never mind. We'll leave it. We'll leave that. If I'd have done this right, I would have used a cell reference so that I could change it in the input table and have everything automatically update. All right. So anyway, once we do that, we can then do our calculations. Notice that I use the aggregate function to calculate the mean, median, min, max. Our risk of loss is about 23%. We can then generate our histograms. So our frequency tables, again, for the mechanics of doing that, you can look at the other two videos where I go through that in a little more detail. And you can see the risk of loss 22%, and yeah, we cross over from negative to positive net present value, probably pretty close to 22% there. And our interest rate was 10%, our discount rate, and so look at where we cross over there, somewhere around there. And so actually, sorry, 10%, and so it's crossing over around there. And so yeah, 22% is about our risk of loss with respect to that. We can then generate our histograms. So our graphs where we have the frequency and then the cumulative frequency, and you can see where we cross over from positive to negative IRR, or from profitability with respect to the IRR and the net present value. So that is a quick look at how you can incorporate Monte Carlo simulation into a process like this. Again, there's a lot of assumptions that go into this with how you're going to set up these distributions, what kind of skewness you have in these distributions. And again, here we are assuming that once you have one of these values calculated, especially for the revenue and the manufacturing costs, it's going to stay the same for all of the for all of the years. And like I said, maybe you want to include a little more. Maybe you think you have a better handle on whether or not things are going to go up and down from year to year, but this is one way to approach the profitability analysis, and I'm certain that the business people could add all sorts of additional factors and complicating factors to this. Whether or not that's going to be more realistic, that's another story.